So the right asset allocation, if you ask me, I have a very simple philosophy. I call it the sleep index.
Okay.
If the market corrects by 20% and you sleep well at night, that's your asset allocation.
I love it. Okay. Yeah.
And that's for you to decide what gets you to sleep well, right? So, but that's the name of the game.
Welcome to Market Pillars Uncovered, the educational series where we bring you powerful insights from leaders shaping India's financial ecosystem. Today, we're joined by an industry veteran, Mr. Amitabh Mohanty, the CEO of JM Financial Mutual Fund. He has an illustrious career spanning organizations like SBI Mutual Fund, Alliance Capital Asset Management, and Carvey Capital, among others. JM Financial Mutual Fund is part of the JM Financial Group, a diversified financial powerhouse with offerings including corporate advisory, wealth asset management, private markets, and affordable home loans. In this episode, we'll dive into debt fund categories, flexi-cap investing, ELSS suitability, investor mistakes that are made, the outlook on India's economy, and of course, high-growth industries that are shaping the future. Thank you so much, Mr. Mohanty, for being with us.
Thank you, Avan, for having me. It's a pleasure to be here.
Okay, so let's dive straight in and talk about the Indian economy, because just a short while ago we were chatting and you were alluding to the fact that it is looking a little bit challenging. So let's break this down. What is it that are the pain points for the Indian economy, and what is your projection as to when we can see recovery and what will lead to that recovery?
So as I said, Avan, growth has slowed down, although the latest prints have been good, 8.2% real GDP growth this quarter. I think what is happening is that the external ecosystem, the tariffs, has especially hit the export sector badly. Wage growth has been slow. So all these things are getting factored into while the government has been trying to increase the consumption story quite a bit. I think it still has to catch on. Hopefully, with the GST cuts, the income tax rate cuts, a lot of money is flowing into the hands of the consumer. Capex has been driven mainly by the government. Hopefully, the private sector will kick in. And therefore, while it is somewhat challenging now, I think green shoots are starting to appear. A lot of bad news is in the market. FIIs have been selling continuously. Rupee has been depreciating, although it looks very bad right now. I think it's a good thing for our exporters. So a lot of these things hopefully should get corrected out in the next few quarters, and we'll see the animal spirits back in the markets.
Yeah, I think that's what everyone is sort of hoping for. But you brought up so many points, so I'm just going to probe on a few of those. You were talking about the consumption story and all efforts being done to revive this. What do you think is keeping us back with respect to the consumption story? Because it's very stark that sort of we are seeing, the rural slowdown a little bit evident, but while we are seeing that sort of luxury and lifestyle consumption picking up, do you think that big divide will still remain?
It will. See, what we are hearing is that the level of indebtedness at the lowest end of the pyramid is quite high. Okay, and that's why a lot of consumption is becoming tough, because people have to manage their own individual balance sheets.
Yeah.
Right? And on the other hand, and that's where you see the divide. You see luxury goods do very well. Okay, a lot of
that
premiumization is happening, and a lot of top-end products are showing very good growth. At the end, on the other end of the spectrum, the lower-end goods are showing a challenging kind of this thing. But as I said, some of these things are getting corrected. RBI, with its latest cut, and is very, very growth-focused, wants to revive the credit cycle, wants to ensure that there is enough liquidity in the markets for the banks to go and lend. So at some level, Avan, I think it is also somewhat of a confidence issue. I think a lot of macros are falling in place, but that confidence or that animal spirit still has to come back, because if you see bank balance sheets, if you see corporate balance sheets, they're looking very pristine. In fact, a bit too pristine, if you ask me.
Too good to be true.
No, not too good to be true, but I think at some level you have to leverage part of your balance sheets, right?
Okay,
So that's a healthy mix of leverage in your balance sheets. I think the pendulum has swung a bit to the other side.
Okay, fair enough. You touched upon the rupee and where we're at now, staring at 90 practically to the US dollar. The exporters, of course, stand to benefit from this. So I just have a sort of obvious question then. Do you think that export-oriented story is going to be the one to really bet on or to look at from the long haul?
Not immediately. I think what we are seeing from the rupee depreciation is some relief. I think they have been hit very badly, especially some sectors.
Yeah.
Like seafood, like gems and jewelry, they have all got hit quite badly. I think the rupee depreciation will give them some relief, but I think the elephant in the room is the trade deal, and we believe it will happen at some point of time in the near future. Can't predict when.
No pain, no gain, I guess. But yes, like you said, that introspection sort of is what is needed, and those dips in the markets are critical.
Yes.
And then you also touched upon the FII selling, which is a little bit worrying. What is it that you foresee when it comes to the liquidity situation in India with all the trade deal talks that are transpiring with the US? Do you think clarity on that front may lead to the FIIs coming back? What's holding them back?
See, I'll tell you that two things, and I'm quite strong. I quite strongly believe that FIIs are rational thinkers, like all other investors. What means rationality for you, Avan and I, will be different from what it means. So, if I look at the FIIs, they saw a situation where the rupee was overvalued and the markets possibly were overvalued. So, we gave them two good reasons to sell and exit. Okay. Along with the uncertainty and that the US markets were doing quite well. So, money moved out mainly to go into the US.
Right.
Okay. So, I think now the rupee has depreciated a lot. I think valuations have either corrected or have gone through some amount of time correction. I think once the trade deal happens, once there's more certainty on the global macro, I think we should see FIIs start to come back. I think domestic investors have held up the markets quite well.
Yeah.
Okay. And as I was reading an article today, I think the markets have forgotten what happens when both DIIs and FIIs start to buy again.
Yeah.
So we should, while we are all correcting to the other side of the spectrum, I think we should also be prepared that as these anomalies or as these overvaluations get corrected, they might start coming back again.
Okay, now let's touch upon the primary market. So much going on there. The number of IPOs, the gush has been overwhelming, I would say. How would you read into these new IPOs coming into the market? What's your view on valuations? Are they unjustified? Are they out of whack? Are they in tandem with what you expected? What's the view?
See, again, valuation is something every entity will have to evaluate on its own. I think that the good thing is a lot of good new businesses are coming into the market.
Yeah.
I think from a broad macro story, I think it enhances India's position in the global stage, that there are so many new age businesses which are now in the listed space and people can take exposure to that. So valuations, again, as I said, fair enough. No one is putting a gun to anyone's head to invest. You can always wait it out if you think that the valuations
What do you think of the valuations?
See, again, as I said, some businesses are good and are at valuations where a long-term investor can still go in and buy. Some of them have been frothy. But again, as I said, who am I to say? I only decide my own actions, right? So, yes, we'll be cautious about valuations. And the most important thing is we want to see broadly price discovery in the market. So we will not be in a rush. Yes, there have been instances where we have participated somewhat in a few IPOs. But I'll tell you where our comfort zone is that let the stocks get listed, let 3, 4, 5 months go. And we have seen that results have sometimes turned negative after a few quarters of the IPO. So we'll wait all those things out. There's no hurry. And when we are comfortable, we'll take positions.
Okay, don't jump the gun when it comes to IPOs.
Don't rush. Don't rush. See, the markets, the biggest maxim, Avna, is don't need to hurry.
Yeah. Okay, fair enough. And patience is the name of the game, I guess, in the
Absolutely,
market.
absolutely.
Okay, I know you said that you're leaving it to the fund managers to decide the sectors and industries, but is there anything in your long-term expertise that you're looking at from a standpoint right now that you believe maybe 1, 2, or 3 sectors look attractive for the long haul?
See, again, I would, as I said, leave it to the fund managers. But I personally believe the banking space always is attractive as a proxy for the Indian economy. I think, but the banking space itself has become heterogeneous with PSUs,
Yeah.
private sectors. Even within private sectors, you have the large ones and the not so large ones. But I think that's a sector one just can't ignore. Even if there's some amount of underperformance, one just can't ignore. But more than that, Avna, I think from a retail investor perspective, or not so retail investor perspective, the biggest thing is to keep things simple.
Okay.
Keep things simple, and I am a strong believer in asset allocation.
Elaborate a little bit more. What is the ideal asset allocation in your opinion? How do we keep things simple?
So I'll tell you the ideal asset allocation, the way I look at
Yeah.
it. It's different for you and different for me, right? I'm on the wrong side of 50, so it's a different allocation for me. So the right asset allocation, if you ask me, I have a very simple philosophy. I call it the sleep index.
Okay.
If the market corrects by 20% and you sleep well at night, that's your asset allocation.
I love it. Okay. Yeah.
And that's for you to decide what gets you to sleep well,
Yeah.
right? So, but that's the name of the game. And personally, I believe India is into a few decadal kind of growth story. So a lot of these short-term blips will keep on appearing and they'll always appear. The idea is to, again, as I said, allocate wisely, be able to analyze your volatility appetite and be able to handle stomach churning movements in the market and stay invested through these periods. And the markets will give you the returns that you're looking for, but it's not going to make it look easy.
And it's not going to be overnight. Yeah.
Definitely not.
Yeah.
Definitely not. But see, again, if you look at wealth creation, it's asset.
Aman.
Sorry, I'm so sorry.
No
Avan.
worries.
So the biggest thing that we look for is one, returns, and everyone is focused on returns.
Yeah.
The second is time, and the third is sizing. Sizing comes from your asset allocation. Time is how long do you stay in the market, and returns is a small part of it. So even if you are in the 12 to 13% kind of returns overall, I think if you size it well, asset allocate it well, and at the end of the day, stay invested, I think you will be very happy with what you create for yourself. It's
You
actually
get a
very
good
simple.
night's sleep.
And you sleep. See, in stock markets, activity is not productivity. Okay,
Yeah.
so you can't just. It's one market which rewards your laziness
Absolutely.
more than anything else. So that's where it is.
Wow, I learned 2 great things today. The sleep index and activity is not productivity. You touched upon the banking index. What about other sectors like, things like defense or maybe niche spaces within the markets that have had their moments of glory? Or, last week we were doing interviews and somehow everyone was talking about the broking business and AMCs doing very well. What's your take on any other interesting sectors or these?
See, again, as I said, stock price movement and a sector doing well are 2 different things.
Okay.
Markets will run ahead of fundamentals and sometimes run behind fundamentals. So the whole thing is you might pick the right sector, but if you don't enter at the right price, you might have a suboptimal experience, right?
Okay.
So for example, defense sector is great, but should you have invested at sky high valuation?
Yeah.
So it all boils down to the fact that there will be a lot of interesting stories which will come out. Insurance is a growth story. If I look from India context, very less penetration. AMCs, we are around less than 7% of household savings in equity. So huge road ahead. Growth story of India plus higher penetration, financialization. Lovely stories, but the whole idea is get your valuations right, do your basic math right, and it's easy, but it's not. It's simple, but not easy.
Okay.
Okay, so as long as you there are a lot of new age sectors which will come. Okay, Swiggies of the world, the Zomatos of the world, they're changing behaviors. But you have to get your valuations right. You don't need to chase them.
Okay.
Broking houses, yes. AMC's big story. We are part of that story. We are trying to be a part of that story.
Yeah.
And we are in that story because we believe in the growth of that. But get in at a price or allocate, do a SIP in some of these sectors. Okay, and the idea is to average these things, get it at a reasonably good valuation, and then stay invested.
Okay.
See, what I worry, Avan, is when I see people jumping in, FOMO happening and all. That's a recipe for disaster.
Okay. Absolutely, especially with these new age businesses.
Lot of them.
Yeah.
Lot of them.
So you need the valuation should be reasonable.
Yeah, you have to just stay calm and let the market come to you, then chase the market.
To make it sound so easy.
It's simple, not easy.
Okay. Now let's talk about JM Financial Mutual Fund. Can you tell us a little bit more about the offerings and some of the milestones?
So again, JM is one of the oldest mutual funds, but we are in a new journey, which started sometime when I joined July 2021, and It's been a good journey. We are, again, as I said, trying to keep things very simple, build a very robust team, robust systems, have a great investment team backed by a good research team. We strongly believe that a fund manager is as good or as bad as his research analysts. Although we see fund managers on screens and all, but a lot of the grunt work is done by the research analyst, which feeds them stories, etc. Yeah. So we are building a very good, strong, risk-oriented, compliance-oriented ecosystem internally. And somewhere we also want to grow the right way.
Okay.
And that's why we would honestly be looking at not a very large basket of products, but products which have a relevance across market cycles and can be scaled up. So our products are normally very simple. We are not into thematics, we are not into sectoral funds. So we want to complete our generic basket and then grow them well with consistency, with lot of should I say, we don't want to be seen as a fund house which looks to hit 4s and 6s all the time. Ensure that your singles are run well, your doubles are run well, and that's how you make long-term sustained return. So it's going to be a very, very value based AMC.
Okay.
And we are putting a alternates portfolio along with a mutual fund portfolio, simple products.
Okay. And
a lot of engagement with our partners, so that ultimately we are also known as a knowledge entity. So we try to ensure that a lot of good awareness, good should I say nudges are sent to our distributors, our partners at this thing, so that we see a very steady behavior, and so that we will not necessarily try to push products down someone's throat. Everyone has their own risk appetite, and we don't want over allocation to risky assets for someone who is not prepared for it.
Okay.
So we want to do it the right way.
So that's quite interesting, and you're talking about the slow and steady game. And then there's, GM is offering the overnight fund, low duration fund, the dynamic bond fund. Can you tell us a little bit more about the debt and the fixed income options?
So I'll tell you, again, obviously the fixed income products took a bit of a hit with the tax arbitrage going out, but I think it's good that now the crutches are gone. People will invest it for the right reasons. Even today, if you look at our overnight fund or low duration fund, even as an asset class, I think they are great cash management tools for investors, both retail as well as corporates, all across the spectrum. I don't think there is any other fixed income product in the whole landscape which gives the returns and liquidity that we do, as well as diversification.
Right.
As well as diversification. Our dynamic bond fund, we manage it so that we navigate the interest rate cycle, both while interest rates are going up and coming down. So our investors don't have to redeem to play the markets. Okay. For example, you have taken invested in a long duration fund during falling interest rates. Now, when interest rates go out, you have to compulsorily redeem and move somewhere else and get hit with the tax thing. So our dynamic bond fund tries to manage it very flexibly. We manage duration. We have gone all the way from 1.25 to 6.5 years, and now we are around 4 years. So we are managing it well so that our investors can sleep well. So again, great products, steady products. Yes, they are not equity products. So in times of bull market, sometimes you tend to overlook these funds. But I think in everyone's portfolio, fixed income has to play a very, very good role of stabilizing their portfolio's.
Yeah, that is true. And then there's the ELSS Tax Saver Fund. Tell us who that you think would be appropriate for, and why did you say that an investor needs exposure to fixed income as well?
See, if you look at, I'll give you a cricketing analogy. Okay. So in the Brisbane Test, which India won, a lot of people remember Rishabh Pant, who scored a swashbuckling 90. Not too many people remember Cheteshwar Pujara on the other side, taking hits, taking blows, staying steady, ensuring that the batting does not collapse during tough times. Okay, which led to that victory eventually.
True.
I believe fixed income funds in a portfolio are like Cheteshwar Pujara, who let you live through tough times, take the blows, and ensure that you survive tough times to make money in good times.
Absolutely. So it's not just about the sixes and the fours and the moments of glory, but someone doing the hard work also behind the scenes to enable that to happen. You spoke so much about valuations, FOMO in the market, and a lot of critical mistakes that investors can really avoid. And in a market like this, you don't want to be burning your fingers. So what do you think for someone who's watching this and they're saying, what would be the top 3 mistakes that I need to avoid when I'm looking at the markets?
First of all, don't go for short-term trading moves. Very few get it right, and they also don't get it right all the time. So while it sounds glamorous, hardly anyone has made money, and numerous SEBI studies and all have shown that trading is not everyone's game. So don't do that. Second is have a very good allocation to equities, especially if you have got 10, 15, 20 years.
What is good a percentage roughly?
See, again, as I said, you starting young, you can have
assume 20s, 30s.
I think you can, if you are 20, 30s, any liquidity which you don't need for the next 6 months to couple of years. You should be putting it, but how you put it is also very important. Don't go all in. If you have got a lump sum, use something like a systematic transfer plan. If you have an income, and I believe, and I strongly recommend all youngsters who are starting their, working lives to start SIPs early. And it's a very simple tool, but it's a wonderful tool. As I said, sometimes simple is all that it takes, right? So ensure that you start the process of investing. So I see most people doing it for DIY, trading, this, that, but none of the simple things are being done, and they are not being done for a long time. I think keep it simple. Don't try to do too much. Don't get into fads. Don't get into fads. Have a reasonably diversified portfolio. And that's it. That's it.
Sleep well at night.
Yeah, see, the point is, this is one thing, one where I think doing the simple things make the most money. See, I always tell a lot of investors, right? Okay, you take it in a very small stock and it becomes a 5-bagger. But supposing you have just done 1% of you will not do a large allocation, right? So 1% of your investable surplus, even it becomes a 5-bagger, it's just 5% right, of your portfolio. But if you have done 50% somewhere or 60% invested in the equity markets, okay, and it gives 15% returns. So that's something like a 9% without sweating it, right? And this 1% 5-bagger is something that will not always come your way, right? So there will be duds which will go down to 0 even. So that's what I'm saying, that people mistake the importance of returns, they underplay the importance of sizing, they underplay the importance of time compounding. As I think Warren Buffett said, compounding is the eighth wonder of the world.
Yeah.
So I think we should remember that.
Yeah, absolutely. And let's talk about mutual funds and the Riskometer. Can you break it down as to how investors should really be looking at this and what it implies for a different kind of risk appetite for each investor?
So I think that's one very good move which has been done by SEBI to ensure that, see, most important thing and which AMFI, us AMCs and SEBI are always worried about is mismatch of investor risk appetite and the products that they invest in.
Yeah.
Okay. And that's where the effort of the industry, the regulator, everything has been to make as much risk-related parameters in the public domain as possible. Okay. And when we see a riskometer and a equity risk would be extremely high or somewhere close to that, it is for the investor to ask questions to their advisors. So if you're doing it, if you're very capable, do it yourself or use a good, knowledgeable, trustworthy, competent advisor and ask these questions. The idea of putting these things out in public domain is to increase awareness and ensure that people ask questions. See, I'll tell you very honestly, Aman, and this is something that I've seen, that when we go out to buy a TV or a fridge, we do a lot of research. But when we do financial investments, hardly any.
That's true.
Right?
That's
so I think those questions need to be asked, and SEBI is making it easier. So two things SEBI has done, some of these riskometers thing and truth in labeling. If you go back 20 years or thereabouts, you could never make out what a fund stands for from the name of the fund.
Got it.
Right?
Yes.
And SEBI
That's
made this move that, okay, standardization of category, standardization of names.
Yes.
And when I see the industry having scaled up so much, I would honestly give a lot of credit to the this thing. I would give a lot of credit to the labeling part of it, keeping it simple, so that when people see a large cap, they are very sure what a large cap means. When they see a mid cap, they do. And that has ensured that decision making has become easy, and that's one of the reasons for scaling up. So that's what I would credit the regulator with.
Absolutely. And what an illustrious career you have had, across companies such as SBI Mutual Fund, Alliance Capital, Carvey. Tell us about, were you always inclined towards the finance industry? Did it happen by chance? What has your journey been like?
No, I was very fortunate that right from day one, I was involved in the mutual fund industry. I started my career in SBI Mutual Fund. Then I moved to Alliance Nippon, short stint at Carvey, then here. So almost the entire life has been as a mutual fund guy, first as a fixed income fund manager and now as a business this thing. So I'll be very honest. I was obviously interested in finance when I did my MBA from IIM Ahmedabad. Finance was one of the areas of my specialization, if you may. Was fortunate that I got into SBI Mutual Fund. And as I said, a lot of people, we discuss in friends how much luck has played a part, right? So the first job in the mutual fund, continued in that industry, enjoyed it. And it's been very, should I say, humbling as well as exciting to see the growth of this industry from 96 onwards. So very happy, very good ecosystem, seen it evolve for the better. And the most important thing, Avan, is this is an industry which has created a lot of wealth for retail investors. Okay. And that is something which I am not very sure too many other industries have.
Absolutely.
Okay. And therefore proud to be part of that.
Absolutely. The wealth generating industry that you have had a role to play in. So what is it that keeps you busy aside of crunching numbers and, being in this industry and working? Anything, any hobbies or passions?
So there are it. Obviously, I read a lot. I always adhere to that old saying, what does he of cricket know who only cricket knows? Okay. So try to have interests outside the world of finance. Because so much of finance is behavioral. Okay. And therefore, if you see life in its perspective, see other things in its perspective, it helps you as a better decision maker. I am a very, hopefully, I can use that word, passionate wildlife enthusiast.
Oh, wow.
Okay. And I personally believe that stints in wildlife get you grounded, get you a better perspective of life, which helps you make better decisions.
Really? Who would have
Yes.
thought? So I'll take recommendations from you as to
For
where
sure.
should go.
For sure.
And of course, cricket, I guess, is one passion of yours.
I do follow cricket. I
Yeah.
have been a big fan of Sunil Gavaskar during my childhood days.
Oh, yeah.
Okay, and while growing up, Dravid has been a role model. If I
Which
may
is
say.
why everything is so solid and steady, even in the way you work, right?
No, so lot of good things to learn from cricket,
Yeah,
and teamwork, leadership. So we take those lessons and try to put them in our world.
No lesson like sport, I guess.
Absolutely, absolutely.
Right? What a pleasure it's been chatting with you. Thank you so much
Thank
for
you,
joining
Avan,
us today.
and pleasure and to be here. And thank you so much.
Thank you. Well, that's all on this episode of Market Pillars Uncovered. Don't forget to like, share, and subscribe to Money TV for more insightful conversations with India's leading market voices. Until next time, invest smart and stay informed.